Markets move fast. Let's dive straight in. You're browsing stocks and you spot it. A 12% dividend yield. That sounds incredible. Almost too good to be true. And guess what? It usually is a trap. Most investors can't tell the difference between a golden opportunity and a ticking time bomb because they never learned how to calculate dividend yield properly. In the next 60 seconds, I'm giving you the formula. And by the end of this video, you'll be able to spot a yield trap before it wipes out your investment. Dividend yield matters. Stick with me. Here's why. By the end of this video, you will know exactly how to calculate dividend yield step by step, avoid the most common mistakes that trip up beginner investors, and use this number to compare stocks like a pro. So stick around, because we're going to break it all down, nice and simple. Okay, so let's start from zero. What is a dividend? Simply put, when you own shares in certain companies, those companies share their profits with you. That payment they send you? That's called a dividend. Think of it like your landlord collecting rent and giving you a cut because you're part owner of the building. Now, dividend yield is the answer to this question. For every dollar I invest in this stock, how much dividend income will I receive per year? It expresses that dividend payment as a percentage of the stock's current price. That's it. Sounds simple, because it is. But the implications? Massive. Dividend yield equals annual dividend per share divided by current stock price. Simple, powerful, essential. Now compare two stocks side by side to see yield in action. Real quick, if this is already clicking for you, smash that like button and hit subscribe so you never miss a video. Now, here's where it gets interesting, and where a lot of people make expensive mistakes. Here's where a lot of beginner investors make a costly mistake. They look at the dividend payment in dollars and think that's all they need, but that tells you almost nothing on its own. Let me show you why with a super quick example. Two quick metric cards, price and dividend, so you can read the winner instantly. At first glance, stock B looks better, right? $3 versus $1, but wait. Stock A gives you a 10% yield, while stock B only gives you a 3% yield. Stock A is actually far more generous to investors relative to its price. That is why dividend yield matters. It's the only apples-to-apples comparison tool. Dividend yield, Jakshru, annual dividend per share, current stock price, x 100. Beautiful, right? Let's go through each piece. Annual dividend per share. This is the total dividend the company pays out per share over one full year. If a company pays quarterly dividends, multiply one quarter's payment by 4 to get the annual total. Current stock price. This is simply what the stock is trading for right now on the market. This number changes every day, which means dividend yield changes every day too. Important. Multiply by 100. We multiply by 100 to convert the decimal into a percentage. This makes it easy to compare across different stocks and industries. Example time. Chalk it up and follow along. Before I show you, example 1, I need to show you something that trips up thousands of investors every year. I call it the yield trap. Here's a quick story. Imagine a stock trading at $100. The company pays $4 per year in dividends. Do the math. That's a 4% dividend yield. Totally normal. Totally reasonable. Then the company hits serious trouble. The stock crashes 30%. Now it's trading at $70. Here's where it gets dangerous. The same $4 dividend hasn't changed yet. So now the yield formula gives you this. $4.70, 5.7% yield. Looks attractive. Suddenly this stock shows up on yield screeners. Investors pile in, chasing that 5.7% return. But why did the stock crash 30% in the first place? Because the company's business is falling apart. Weeks later, they announce a dividend cut. The yield disappears. The stock drops further. Investors who chase that yield lose money on the stock and lose the income. That is the yield trap. And that is exactly why you need to learn to calculate and understand dividend yield yourself. Okay. Now let's get into the actual calculation. Let's walk through our first example. I'm going to go slow so everyone can follow. No rushing. Example 1. Fictional company. Steadycorp Inc. Company. Steadycorp Inc. Current stock price, $50 per share. Annual dividend per share, $2.50. Step 1. Write down the annual dividend per share, $2.50. Step 2. Write down the current stock price, 50.0. Step 3. Divide 2.50, 50.0 or 0.05. Step 4, multiply by 100, 0.05x 100, ROE 5%, Steady Corp's dividend yield, ROE 5%. So what does 5% mean in real life? It means for every $1,000 you invest in Steady Corp, you would receive $50 per year in dividends. If you invested $10,000, that's $500 a year, or about $41 every single month just for holding the stock. That's passive income, ladies and gentlemen. $10,000 invested pays $500 yearly. Clean, predictable income. Now let's try this with a real-world style scenario. The kind of calculation you'd actually do before investing. I'll use a generic utility company as our model, since utility companies are famous for steady dividends. Example 2. Utility company scenario. Company type, large utility provider. Current stock price, $62 hours. Quarterly dividend per share, 0.78. Step 1. Calculate annual dividend. 0.78 per quarter times 4 equals $3.12 per year. Step 2. Plug into the formula. Dividend yield equals $3.12 divided by 62 hour times 100. Step 3. Do the math. $3.12 divided by $62 equals 0.05 rows 3. Multiply by 100 gives 5.03%. Dividend yield equals approximately 5%. Now, a really important note, and pay attention here because this trips people up all the time. Most financial websites like Yahoo Finance, Google Finance, or your broker's app will show you the dividend yield automatically. But, and this is critical, those numbers update based on the current stock price. So if the price drops, the yield goes up. If the price rises, the yield goes down. Always double-check the numbers yourself. Alright, this section is critically important. I see these mistakes over and over again from new investors, and they can be very expensive. Let's make sure you never fall into these traps. Mistake number 1. Forgetting to annualize quarterly dividends. Many stocks pay dividends every quarter. If you only use the quarterly number in your formula without multiplying by 4, your yield calculation will be 4x too low. Always annualize first. Mistake. Number 2. Chasing extremely high yields. A 15% or 20% yield sounds amazing, but it's often a red flag. It may mean the stock price has crashed dramatically, making the yield look high, or the company is paying out more than it earns and a dividend cut is coming. Mistake number 3. Treating yield as a guarantee. Dividends are not guaranteed. Companies can cut, reduce, or eliminate dividends at any time. The yield calculation is based on past payments. Always research whether those payments are sustainable. Mistake. 4. Ignoring the stock price movement. If you buy a stock for its 5% yield and the stock price then falls 20%, your total return is still negative. Dividend yield is one piece of the puzzle, not the whole picture. This is the question every new dividend investor asks, and the answer is, it depends. Let me give you a framework. High yield, 5% plus. Low yield, 1.3%. More immediate income, usually higher growth potential. Often mature, slow growth companies. Companies reinvesting profits to grow can signal financial stress, often financially very healthy. Good for retirees needing cash flow. Better for long-term wealth builders. Examples: utilities, REITs, telecoms. Examples: tech firms, consumer brands. The sweet spot most financial experts suggest? Something in the 2% to 6% range, combined with a strong history of dividend growth. A company that's been raising its dividend every year for 10, 20, even 50 years? That's far more exciting than one with a suspiciously high yield. Okay, so now you know how to calculate it. But how do you actually use it to make smarter investment decisions? Let me give you a simple 3-step process. Step 1. Use yield to screen stocks. Set a minimum yield threshold for your search. If you need income, maybe you filter for stocks with at least 3% yield. This narrows your list from thousands of stocks to a manageable group. Step 2. Compare within the same industry. Never compare a tech company's yield to a utility company's yield. They operate in completely different contexts. Always compare apples to apples. Compare Bank A's yield to Bank B's yield. Step 3. Look at dividend growth history. A company with a 3% yield that has raised its dividend by 8% every year for 15 years is often better than one with a static 6% yield. In 10 years, the growing dividend may surpass the static one. 3 profiles side by side. Income stock, higher current yield, slower dividend growth, best for reliable cash flow and retirees who value checks today. Balanced stock. Mid-range 2 to 6% yield with steady increases, blending income and growth for most investors. Growth stock. Tiny yield now but rapid dividend hikes, driven by reinvestment and earnings expansion, ideal for long horizons. For each, scan price trend, payout ratio, and 10-year dividend history. Favor companies that grow earnings, cover dividends comfortably, and avoid cutting during downturns. Match the profile to your goal: cash now, balanced mix, or compounding growth. Then verify sustainability before buying. See how different these are? The 8% yield on the income stock looks incredible, but notice it has flat to declining dividend growth. The growth stock with 0.8% yield has 15% annual dividend growth. In 10 years, its dividend could more than quadruple. There's no universally correct choice. It depends entirely on your financial goals and stage of life. All right, let's bring it all together. Here's everything we covered today in a nutshell. Your complete dividend yield checklist. 1. Dividend yield. Cautious. Annual dividend per share. Current stock price. X 100. 2. Always annualize quarterly dividends before calculating. Multiply by 4. 3. Dividend yield changes every day as the stock price moves. 4. A very high yield, 10% plus, is often a red flag. Investigate before investing. 1. Compare yields within the same industry for fair comparisons. 6. Look for consistent dividend growth, not just the highest current yield. 7. Dividends are not guaranteed. Always check the company's financial health. 8. Use dividend yield as one tool among many, not the only one. And that's a wrap. You now know exactly how to calculate dividend yield step by step from scratch. You know how to avoid the biggest mistakes, how to compare stocks intelligently, and how to fit dividend yield into a real investment strategy. Now I want to hear from you. Drop a comment below and tell me, what's your target dividend yield when picking stocks? Let's get a conversation going. I read and reply to every single comment. If this video helped you, and I really hope it did, please give it a thumbs up. It takes 2 seconds, and it makes a huge difference for this channel. And if you haven't already, subscribe so you don't miss our upcoming videos on dividend investing strategies, how to build a dividend portfolio from scratch, and which sectors historically have the strongest and most reliable dividend histories. Until next time, keep investing smart, keep learning, and remember, the best investment you can ever make is in your own financial education. I'll see you in the next one.